Hi, and welcome to this week's episode of the CostofCarry podcast. My name is James Chi. Let's get started. I wanted to start off this episode reflecting on the recent rate cut that was passed by the RBA last week. I mean, 0.1% is pretty incredible, and there were also talks on that release that there wouldn't be a further cut or increase for another 3 years, which is obviously unprecedented. Obviously, we had a few consecutive periods a while ago about no cuts, but now we're definitely in uncharted territory. And given what's happened in the past calendar year, this rate cut has obviously been in line with many of the expectations of the market, and it wasn't too long before many of the lenders or institutions also, following the release, went and amended or adjusted their products, to reflect the rate. And now that some rates are below 2% in some instances, or close to it, and we're also heading into the final weeks of what remains the 2020 calendar year for the lending markets and property markets. I can't stress enough how important it is to consider, plan, and take advantage of some of these offers over the 4 to 5 week shutdown that's going to be happening over December and January. And of course, there's always going to be cashbacks and pricing promotions available from different lenders at different times of the year. So there isn't really an excuse for saying that I'll wait for my bank to adjust my rate before I do anything. There's no obligation for your lender to pass on the rate cut, because what this rate cut indicates is that that lenders will receive less return on their money that they lend to you, on the interest portion of it. So then this rate cut or this pricing adjustment poses the question of where else can lenders make their money. And for some, it's not going to take effect, but for others who may want to price a product in a certain way, there are obviously a few ways of doing it. For one, you can tighten the criteria for the borrower, and what this means is that you're basically filtering out who can borrow, or how much they can borrow, or why they can borrow, for example. So is it a reduced loan amount? Is it a reduced loan to value ratio? Those are just two primary examples. Some others can include, does it come as a package deal with a card or a monthly account fee, a yearly fee, an annual review? No first home buyers, no investment properties, no basically everything that's... There are many ways to structure it, and more often than not, the lender will want to have a little bit of certainty in how they can entice borrowers to get in, because obviously not everyone's going to be applicable nor eligible for these types of promotions. And I suppose that's why this highlights the importance of discussing with your banker, but more importantly your mortgage professional, whether or not you actually qualify for these products, as the criteria is often more strenuous or to satisfy compared to a more general and vanilla off-the-shelf type of product. So what you expect versus what you can get can be two totally different outcomes. So having the objective and neutral third party involved, which in this case would be a broker, to help manage those expectations and navigate the intricacies of the policy in order to get the best outcome for your circumstances, is really important, because obviously you don't want to feel left out and excluded from these rates. If we can provide you with a valid explanation of why you can't apply for these loans, then I think that ends up being really helpful in preserving your not only credit worthiness, but also your a consumer's trust in the industry as well, because we're obviously in the service provision aspect of it. So generally, and it's interesting to think about that, because generally with the effect of quantitative easing, there should theoretically be more money that moves out of deposit accounts and savings accounts that are moved into the economy, and so get recycled. So the money gets recycled. So it will be interesting to see how consumers respond, because the return on savings, like in your deposit account, is virtually zero, or near zero, sorry. But at the same time, if we're talking about, or maybe there's some sentiment in the market about moving these funds into property, well, how many people do you know that could have savings, that have an amount of savings that could be used for a home deposit? And that's obviously not the only case. You can do it for home repairs. You can do it for credit repayments, possibly even other investments in the share market. So, using an example, and again, this is totally, don't try and apply this to yourself, because I've just made it up and your situation may be different. But let's just say, for example, that there's a home buyer who qualifies for a, and that's the important word, is qualifies for a 2% 30-year principal and interest loan up to 60% LVR at a maximum lend of $500,000. Now, let's also say that this home buyer has bought a $1 million apartment or property, doesn't matter, over in Hurstville in New South Wales, or Sydney, New South Wales. And look, sure, the rate is great, but look at what the demand for Hurstville property has caused to the price. This home buyer's paid clearly more than what they can suitably borrow, and look, we'll assume just regular average expenses and income, but it's not suitable for them to say borrow. It's not suitable nor possible for this person to borrow more than the 500. Now, look, maybe they would have done, if they did their research or saw a mortgage broker, they would have found out beforehand, before they committed to the purchase, that they weren't eligible for, or while they were eligible for this great, this really, I suppose, cost-effective product, that is not suitable to what they need, because clearly there's a difference of of over 500,000 just to make settlement. Now, is it, again, going back to the details, how many people do you know have $500,000 in savings to make up the rest of the equity in the property for all the balance on settlement? It's very limited pool of people that actually can say that's what they have. And with this in mind, it becomes more of a topic of what's more appropriate. It becomes more appropriate then to determine how much you need or can afford before you decide which product you want. Now, that's again the part of the role of the mortgage broker in terms of responsible lending and the soon to be best interests duty. It can be a very fine line, and having a mortgage broker who is able to get you maybe that pre-approval or maybe assist in that home buying can be greatly useful in trying to navigate all these flashy words and flashy products that are thrown out and marketed to people, which can be overwhelming in some instances. And on that note, that concludes this episode of the Cost of Carry podcast. Thank you all for tuning in, and I'll see you in the next episode.